the idea that it's a set it and forget it, that is not the case. Like, it's active for a reason, right? It's active because, in the span of 30 days, you could have 10 people, 10 stays in your property, 15 stays, it's really a nightly rental scenario. But where that's appealing from a tax standpoint is now it's treated as a business, right? To the IRS now, this is really, you are actively participating in a business. This isn't just passive and, something that you have one renter and they change hands every 12 months, but this is really an active business. You're marketing for it. You're, taking new pictures. So it's work. But, I think the other side of that is you are also in control. Because I think what I've seen, especially in the short-term rental, is you now have an investment that you're able to, truly change on a monthly basis.
Welcome to the Real Estate Mogul MD podcast. Thanks for tuning in and taking control of your financial future. This is a show where we not only motivate and inspire, we give you actionable real-world experience to help you live life by design. You'll hear journeys and stories from other physicians, investors, coaches, consultants, and entrepreneurs. And now, here's your host, Brett Riggins. Hey, everybody. Today, I'm joined by Anee Gannon, a former pro golfer turned tax strategist and real estate financial expert. What a better way to learn about taxes and real estate and wealth building than on the golf course, huh? She helps investors and business owners understand the real numbers behind wealth building, from tax planning to cash flow strategy. If you want to keep more money, if you want to keep more of what you earn and grow smarter as an investor, this is the episode for you. Well, good afternoon and welcome to the show. How are you doing today?
No, very good. Thank you so much for having me. I'm really excited.
And I say afternoon, but I never know sometimes where I'm talking to the person or the guest at. I mean, we've been all over the world speaking on these podcasts. So where are you located at?
I'm actually outside of Philadelphia. So
outside. So we're all on the Eastern train here. Yes. Very nice. How's the weather? How's the weather today?
Looking a little more like spring than it was last week. So
is there snow on the ground still?
No, it's melting. So that's
melting.
Nothing.
Just the big piles, right?
Yes, exactly.
Oh my goodness. Yes. So I lived in the north for quite some time and moved down here to South Carolina, actually. Wow. And I love torturing the people from the north and say, hey, after this, I'm going to go outside by the pool and take some sun rays in.
I know. Oh, well.
I was up there for 40 some years, so take it. You can move too. No, it's lovely. When we talk about this sometimes too, and how much the weather affects our state of being, our state of mind. Yes. And it's just something special. When that door is open, the windows are open, the sun's shining coming through, the wind breezing through. It's just amazing. Yes. But other ways that we can find to raise our state of mind is to do something we love. And something that you love and passionate about has to do with taxes. Tell us a little bit about that.
Yes. So, I started, my first love was actually playing golf. So, cool. I played golf growing up all through high school, college, and a year professionally. But I feel like it gave me a really good picture into life, right? So most 20-year-olds weren't hanging out with a bunch of old people on the driving range. And I was, right? So, sort of really got to understand, your entrepreneur, but also how people had been really successful in life and were able to, retire really well. Because where my coach was happened to be like a really nice country club. So I got to kind of see firsthand, even though that wasn't, my reality with my parents, it really was interesting to see these people in their 60s and 70s, just really happy and, for the most part, enjoying life. So, fast forward, I ended up not playing golf, ended up going back for my master's in accounting. I became a CPA, started working at a big firm in Boston, outside of Boston. And what I realized is that my background was just very different from most accountants, because most accountants hadn't had these years of spending time with people much older, much more established than me, and sort of being that, fly on the wall. And so when I started to look at tax returns, I thought, what's really, broken or an opportunity is that if you have the busy season approach, you never get to have a conversation with your client, right? You're just getting the return done. You're up against a deadline. It's rush. And where we as accountants can be most valuable is looking beyond just this year, but really, what are you trying to do, right? What is your goal? What are you, strategy? And do you even understand, how you're being taxed? And a lot of times, no. And so what, I've really tried to do for the last, 15 years out on my own is really build a process to where we can engage with people throughout the year and really work on educating them on taxes, right? Because most people really don't understand this whole convoluted system called taxes. But then ultimately, how can you strategize to make sure that you are, building the life that you want to have when we get to retirement? So, especially over the last 5 years, we've actually gotten much more involved in real estate. We were always involved in real estate because most of our clients are either business owners, entrepreneurs, or higher net worth, who probably own some real estate. But what I've seen, sort of in the wake of the pandemic is the idea of, inflation has become the reality. So our old way of thinking about long-term planning and long-term tax strategy, really has seen that there's much bigger benefit than there ever has been of, really diversifying into real estate to be able to both control how much I'm paying in taxes every year and really make sure that I'm building wealth in a way that's hedged against inflation.
Mm-hmm. Well, what an awesome journey too, to have that experience to be around golf, because golf is just one of those sports. It's a lifetime sport. Like you can be really, really old and still, go to the front tee and hit it 15 times and get to the green and still have a great time. But the camaraderie, the relationships, the conversations, the communication that you have in those times is awesome. And you got to spend that. And one of the things that I talk about a lot, Anne, is expanding your associations. And what a wonderful way to do that for you when you were younger, being around those people who, even though you may not have known at the time, or may have been the person that you wanted to become at the time, whether it's finances, relationships, leaderships, or whatever. So you've expanded your associations unknowingly, grabbed this whole new world of taxes, went back to school. And now here you are talking about real estate and being proactive versus being reactive, giving you the ability to connect with your client. And for the listeners out there, I can be certain that they would appreciate that with their patients as opposed to clients, because the ability to have that conversation with them, to not being cranking through the system in the process of just turning out cases or turning out people or patients or clients. You really get to build that relationship and learn more about the person and their needs and their wants and some of their challenges. What are some of the biggest, so you've worked with over 500 businesses. What are some of the biggest challenges that you found when it comes to taxes in real estate?
I think it's more understanding the nuances of the rules, right? I think first understanding, your goal of real estate, is it really helping you on a tax return or is it not? That passive versus active rules. And I think the key is, I was joking with my clients of turn off the social media, right? Like it's not one size fits all when it comes to tax strategy, that it really starts with understanding your specific picture, your job, your primary profession, your property that you currently own, and then making sure that you structure it in a way that you meet those goals, right? That you hit, whether it's, effective tax rate, lowering effective tax rate, or just understanding tax and really more scaled to building long-term wealth. That's really where it starts, is just, understanding that. But I would say, I think one of the biggest challenges as, the world has changed over the last 10 years is, taxes have definitely gone up. I think that's one of the biggest realities, especially if you're living in one of the northern states or western states. You're looking at people who are, mid 40s as an effective tax rate once you factor in that state tax. And that's a huge chunk of, you go to work every day and,
and half of it you don't bring home.
Right. And so, I think it's a reality we have to face, because taxes haven't gone up for everybody, but they have gone up for the higher net worth people. And that's okay. It's what it is. It's not saying that we don't want to pay into the government, but we just have to be aware of your reality, because that's where the biggest thing that I've seen over the last 5 years, especially, is just that you're bringing less home, right? Like the states are enacting more tax, the cities have tax, Massachusetts has a wealth, there's crazy taxes that did not exist 5 to 10 years ago. So if we're still in the same planning mode that we were in 5 or 10 years ago, that's probably not what's going to serve us today, because we're fighting this losing battle in this mid-40s effective tax rate. So to me, it's being honest about our effective tax rate, all the ways that you're earning, having those conversations, if you're investing in a portfolio, like making sure that broker understands where you are, and then exploring other options. Is there a way that you could lower your effective tax rate, or at least, not hurt it, right? So, and just being more in control, because ultimately I think it's an area where people feel like there's nothing I can do. And that could be the case, but I think at least educating ourselves on your specific tax picture. And then I think the other reality doesn't really exist anymore is the idea that you're going to pay less in taxes when you retire, because again, taxes have gone up for higher net worth people. So I have one guy who's like, look, it's never going to go down. Like, I know that, right? Like, I'm not going to ever make 50 grand a year. So like, let's not do like deferred stuff, because what does it matter? And so I think that's the other reality that has truly changed in the last 5 or 10 years, because the way they've shifted the brackets and all of those things, which we can't control. The reality is your rate you're in today is probably where you're going to be, unless you drastically change your lifestyle, which you probably don't want to do that either. So, so those are the things I think it's time, as a collective, to like reassess our tax picture, so we really have the reality of what's going on in front of us when we're doing our planning.
So fighting a losing battle, I think that's interesting in convoluted tax code. And you can literally measure the stack if you're in either letter or legal side pages. You can literally measure the stack with a ruler or tape measure. The length of this code is insane. And fighting a losing battle is very interesting too, because we're here in the beginning of 2025. We're, hearing chatter of removing income tax, this crazy stuff like this, whether you believe it or not, it's chatter.
It's true.
and removing the IRS and the Doge world of Department of Governmental Efficiency, all of this stuff happening. But I just say that because we're paying all of these taxes and fighting this losing battle to get this money to go where? That's why I say that piece. Where is it going? So if from that side, if it is looked at differently, where's the money going? How's it going? Just imagine the millions and billions of dollars and hours of our life and stress that we would get back if something like that were to come to fruition. And even if it takes years, decades to happen, wow, that would be so amazing if we didn't have to fight a losing battle all the time and just understood, hey, this is what I'm going to pay in taxes. And, depending on how those are collected or what they are, it wouldn't be as difficult to understand what we're going to make. And that idea of like, hey, I'm going to go out and make $1,000. I'm only going to bring home $500. Where's the rest of that money going? And come on, you don't have that answer. But that's the piece that's tough. No,
but I think
tough.
Even if you can't control that piece, at least being honest about what that percentage is.
Yeah.
Because at least then it's not a surprise at the end of the year, because now you can actually plan for it. And you can now look at your, if you're a high net worth W-2 earner, like look at your withholdings. Like then we're not in this world of like, we feel reactive. It is what it is, like if I choose to live in New York City and I'm a higher income earner, I'm probably in the mid 40s by the time I understand my city tax. But let's understand our city tax. So that way we're not stressed. We're not, it's a decision, it's a choice, and it's a great choice. New York City is awesome. But like, I think too many times we just hide away from these other taxes, especially the state and city, and, don't realize that that's what you're actually paying. That it's not about what you're writing the check for at the end of the year. This is what you've actually paid in real dollars. And I think where that's important is there are things you could do, whether it's, be actively involved in a business or, actively involved in a, short-term rental potentially. Like there's things you could do to lower that tax rate. But, and they're, legal. It's not, avoiding taxes, but it's just giving you the knowledge of, this is that next step of here's what I could do to get my tax rate down 5%, potentially. And if at my income level, that could be a big number.
So when we talk about effective tax rate, and I just want you to break that down really quickly. But before we get there, that's income. That's income. And there's so many other taxes that we pay. I literally could cry in the amount of taxes that we pay for real estate taxes. It has nothing to do with my income, right? It's real estate taxes based on the property, how they're assessed, how they're increased. It's a whole nother world. But besides that, I'll set that aside. I set my tears aside, Ian. This effective tax rate that you're talking about, just for me not knowing anything, help me understand what effective tax rate is.
Yeah. So what I like to do, because the tax, like you said, the stack, it's convoluted. It's meant to not be understood. So what I like to do is just say
that's frustrating. I'm sorry.
Well, only because of like all the, both sides fight, and we've had all these like Band-Aid things that don't work.
Ridiculous.
It is what it is.
So anyway, effective tax.
What I like to do is just say, basic math, right? Here's my total tax on my return. Forget the payments. Here's my total tax. And here's my taxable income. So taxable income divided by tax. And that's what we come down to. And how we got there, self-employed, like all these other things, it doesn't really matter because that's my starting point. Because with that number, then I want to factor in my state rate, right? So my effective federal rate, my state rate, because state rates also now are starting to have sliding scales where, for the longest time it was just fixed, but now certain states, if you're over a certain income level, it's a different percentage. So all of that in city, is there a city tax? Then what I do with our clients is build out some scenarios, right? So whether it's, a pre-tax retirement account or whatever you're thinking, investing in a short-term rental, investing in a whatever it is. But with that in mind, we can play out what of your options will change your effective tax rate and which won't. And that way you're in the driver's seat to say, if I know I have $50,000 to invest, let's make sure that I plan it out on the tax side to at least understand, yes, it's going to change things, or no, it's not going to change things. Because I think too many times we're reactive and not paying attention to the different tax rates that exist.
And when you say that, like that mid 40s number, you're consolidating those other pieces, city and
right? Because if you live in New York City, right, your return, you're going to have a federal, then you have your state and your city. So especially digging in, I think, especially those that live in states that have, more nuanced rates, digging into that state return, because too many times we forget about it. And then it's like, wait, why do I owe the state?
Right.
And usually there's, Maryland has one. There's usually these weird like city rates that have crept in over the last 5 years as cities and states need more money. And all of a sudden, now we're paying a lot of tax to 2 or 3 different places.
And another thing that I loved when I heard you say this was, and it's a mindset piece, not deferring anything, like paying the taxes out front, because, this is so weird because we're so all taught, like, it's better to, do this or do that. But things are so fluid. Beyond us, the things that we have control of, things are so fluid. It's so hard. So if we talk about IRAs or self-directed Roths, or things are so fluid, it's hard to plan for a long-term scenario. But the not deferring the tax piece is very interesting, because there's probably a lot of listeners out there like me. I don't plan, like you were saying, I don't plan on making less. The only thing that I plan on doing is exchanging my active with passive.
Right.
I'm not going to make any less money, right?
Right.
Why would I plan to do that?
Right. And so that's where, taking that time to say, okay, what would that passive income look like from a tax picture, right? Am I taking money from a retirement account that's now taxable? Is some of it not taxable? And just building that out, because then you could see how much your picture really is going to change. But in most cases, what I see, because I do a lot with, people who already are retired as well, is like, it really doesn't change, because you're taking money out of these accounts. That's taxed. You have capital gains. That's taxed. You have some real estate, and now that's paid off. So it's more profitable than it was before. So, all of that together, I think you just get a better picture. But if you can do that now, then it's not this stressful thing. Because what I hate to see is, the clients that I have in retirement who didn't plan, it's very stressful because they feel like they're getting taxed all the time. Like I need, $1,000 to go to the doctor. I have to pull it from my retirement account. Well, now I'm taxed on $1,000. I don't want to pay tax right now. So nobody wants to live like that. You've worked too hard and been too smart to like have to pinch pennies in retirement. I don't think you have to if we can understand this piece of it.
Yeah. My father-in-law, he's was definitely is a mentor for me as I progressed through the entrepreneurial world, a business owner world. And he would say, it's making money is the easy part. Keeping the money is the hard part. And being able to keep what you make is the difficult part. So in this idea of active and passive, that brings a whole nother world, because, whether you know it or not, we can't use passive losses to offset active income. And I always consider them in buckets. But there's this thing that's happened lately with real estate investments to kind of jump across these buckets. It's the short-term investment world, short-term rentals, Airbnb world. You've worked extensively in this particularly. Why has this become so popular? And what should investors know before jumping into the short-term world?
Right. So I definitely think, the idea that it's a set it and forget it, that is not the case. Like, it's active for a reason, right? It's active because, in the span of 30 days, you could have 10 people, 10 stays in your property, 15 stays. It's really a nightly rental scenario. But where that's appealing from a tax standpoint is now it's treated as a business, right? To the IRS now, this is really, you are actively participating in a business. This isn't just passive and, something that you have one renter and they change hands every 12 months. But this is really an active business. You're marketing for it. You're, taking new pictures. So it's work. But, I think the other side of that is you are also in control. Because I think what I've seen, especially in the short-term rental, is you now have an investment that you're able to, truly change on a monthly basis, right? Really find your break-even point, grow your revenue. I mean, just like you would another, true operating company. This is your new operating company designed as a house, right? But the other side of that is now the losses they're active, they're ordinary income. So, what I've seen is you're able to lower that effective tax rate, 5-10% in some cases, get, some of your withholdings back in that first year and really build a strategy where you're reinvesting into additional assets, over a 5-year period. And, I think the other piece of that is, even if the property breaks even from a cash flow standpoint, what's interesting is that mortgage is basically getting paid by your renters, right? So you're basically holding this property that you are getting more equity in every year without any additional money out of pocket. So yes, you had your initial, setup, startup costs, but over a 5 to 10 year period, that's where the magic happens, because now you've really grown this equity to where, your net worth is higher, without really having a lot of out of pocket expenses, because you're, breaking even and getting all this revenue on the rental side.
I love it. I call that stackable returns. In this asset class offers this thing that many others can't even fathom or couldn't even put this together. But a piece of that, like you said, is the principal pay down. As the tenant pays the rent, the note is serviced. And that principal, which is another weird thing. I just guess I'm in complain mode here about accounting. My cash flow, if I'm looking at a P&L and I go to pay this principal, it's removed. So it doesn't even show as an expense on my P&L. It's removed and it's capitalized and pushed over, right?
But the depreciation, right? On the flip side, if you
does that make sense to you? The cash flow, it's like I can't even that cash is not in my bank anymore, and it just shows on my P&L. It makes me crazy.
But on the flip side, that first year you bought the property, if we were in a bonus depreciation world, you maybe wrote off 30% of that property in the first year, depending, obviously. Yeah. And then every year after, there is this depreciation chunk, which isn't coming out of your bank account. So I agree. Yeah. But that's where I think part of this is understanding what depreciation is that, it's really this piece of a pie that, strategically you could take a bonus, write off more at the beginning. You can choose to write off less at the beginning, depending on what the asset is. But it's a part that investors need to understand, because that's where some of the strategy comes in is, strategically taking more up front, knowing that I'm going to have less in future years, but also knowing that my strategy is I'm going to buy another property 2 years from now or 3 years from now so that I'm growing my equity.
So this cash flow thing, it's very interesting, and tying this world together, just like in the tax world, there's CPAs, there's consultants, and then there's attorneys, and there's always there's fingers pointing back at each other on who can do what and what's the better way. But in this world of cash flow, it's like this there's the P&L, and then there's the balance sheet, and how in the world do these things mix? I don't know two entry types for QuickBooks. Like, I don't know these things. I just want to know like how this property is performing. The difficult piece then is if we're trying to avoid or minimize taxes, we could actually lose cash flow doing this. And in so many years, we've been just cash poor. One, because we put a lot of money in assets, and we're trying to track that through our P&L and our balance sheet. Like, where is this money going? Because I'm paying taxes and I have nothing in my bank account. What in the world? So do you have any suggestions for us who aren't accountants and are kind of like trying to juggle all of this stuff, but trying to track that cash flow versus tax thing?
So I definitely think using, you mentioned QuickBooks, but whatever your accounting software, I love the statement of cash flows because that really does tie back to your bank account. And I think that's the most important part. As an investor, the tax is what it is, and we need to understand that. But I do think as an investor or a business owner, you really need to understand that statement of cash flows to say, be honest, right? If my bank account went down, then this property is not cash flow positive. And that's okay, because it could have gone down because I paid off my note, or I paid down my note, or I made extra principal payments, or I did an improvement, whatever it is. That statement of cash flows will show us that, because it'll show us, in addition to the net income. So I'm showing, 20 grand of net income on a property, but I had, a $15,000 improvement and I paid $15,000 to principal. Well, I did lose 10. That's okay though, because that was strategic, right? Like I now have an improvement and I have paid down.
Strategic as long as you know it.
Right.
Yeah.
Yes.
Otherwise,
and on the flip side, I think what I see a lot is then you have the person who's saying, "Oh, I'm just going to sell," and you're like, "Well, no, don't sell. Like that doesn't mean it was a bad year. It's just that these are what happened." So I definitely think if you haven't pulled the statement of cash flows, even if it looks bizarre, try to go through it. And what you'll find is it's the truest test to make sure that your accounting is correct.
Statement of cash flows. I love that. I will dial into that and check that out. It's probably one of those things that accountants just provide to you over the years, and my eyes just glass over. I'm like, what is that? Yes. Balance sheet. I have no idea what retained earnings are. Get that out of my face. I still don't understand retained earnings. But anyway, I've had some time looking at these sheets, probably like you, but you understand them. So the statement of cash flows, very interesting. Where do we go from here? What do you suggest other to the listeners that would help them get ahead of the game, who may, be like me and their eyes glass over when we're talking about depreciation or capitalization or statement of cash flows? Like, what do we do if I've got 5 properties and I don't want to be a CPA?
Right. So I definitely think if you already are a property owner, what I really like to do is build out what I call our rent roll, which is really looking at your property over the next 5 years and factoring in some level of inflation, right? Because even if we say 2% a year, here's what my rents would be in 5 years. Here's what my operating costs are going to be in 5 years. And then here's what my equity is, right? Because as my rents go up, my equity will be paid down in 5 years. So I think that can help us to see, okay, even if the property is cash flow positive or just break even today, what is it in 5 years? And I also like to look at that equity piece as a percent of the property, right? So if I look at it, do I have 20% equity in 5 years? Do I have 30% equity in 5 years? Because that helps me to know, would I have the option, what if I sold, what would happen if I leveraged it to buy an additional property? So I think really factoring in that equity piece of the property is very important. And then I would say to anyone listening, whether you own a property or not, when you file your return this year, just take, whether it's an Excel, you can do this on the back of the napkin and literally go through the first 2 pages. Take 20 minutes and go line by line just to understand all the different ways that you're taxed. Because it's not right or wrong, but you have to know that. And I would say my most successful, my highest net worth people, they already know their effective rate, for better or worse. Yeah. And then they use it in all their decision making. So once you know that, now the rest of the year, someone comes to you for an investment, someone comes to you to put money in retirement, like you already know how you're taxed. So you don't have to learn the tax code. You just have to really understand your tax return. And those first 2 pages, and then if you're a state return, same thing, just that summary page. and just really focusing on taxable income. How did we get there? And then total tax. That's it. And everything else, it's part of it, but those are the two key numbers and really coming up with that percentage.
Yeah, if we could break down that stack of papers that easily too, that would also be helpful. Long-term solutions versus those first couple of years in this perspective of keeping equity as a piece of. So again, this is another thing where these sheets don't really take this into account, and there's not like this easy user interface where I could click and say, "Oh, here you go, Brett. This is what you need to do," right? Although I'm working on it, so stay tuned. But if I have this like user interface that takes all this into account, especially the equity in the piece, because that equity can be to your advantage, although it may be struggling the first couple of years. For 5, 6, 7, 8, 9, 10 years later, you've got this equity built in that you can actually then refinance, pull this capital out, which is a loan. It's not a taxable event. So you're pulling the principal back out of this property and not getting taxed on it. It's a beautiful thing. How do I tell the listeners out there that those first 2 years of stabilization may be rough? And if they may not hit projections right away, it's about the long term. These are long-term solutions. How do we communicate that?
Right. And that's where I think it's an education, just like you would if you were going to go to a broker and build out, a retirement strategy. This is the same thing because like you said, it doesn't really matter if it loses 10 or 20,000 in the first 2 years, as long as I know it's going to get back that in 5 years, right? So that's really where we're looking is what is that break-even point? Hopefully it's today, but if it's not, what do I need, whether it's the revenue side or just the time side of, the mortgage to really make sure that I get to break even. But I would say for most, investors, if you're looking at the long game, it really also is about that other piece of, is the goal to maybe pay it off earlier. If I have extra cash, maybe my goal is to pay this off sooner because the magic happens when I'm retired and this property is paid off because you've literally then created your own pension plan because now the rents are hedged against inflation. So again, my happy retired clients are the ones that have real estate because eggs are more expensive and their property's worth more, right? Yeah. So they're not mad about that. And so if you have this property that's now paid off, rents going up just means that, yes, it's gotten more expensive, but someone's going to pay me more to be there for whatever length of time. So that's the magic that we're trying to get to. And yes, it's great if it has wins right away, but those wins are the big wins to where you really have complete peace of mind in retirement.
My happy retired clients own real estate. I love that line. Absolutely.
So true.
Retired clients own real estate. That idea of hedging against inflation, eggs being more expensive. I mean, there's so much to that piece, but it takes time. There's no easy button yet. I don't know that there ever will be. And if there was, then the returns wouldn't be the same. There's no easy button and it takes time. You can't plant a tree and then tomorrow want to go pick the fruit from it, right? So this is long-term solutions, but you have this thing called Accelerator Method in long-term wealth growth. Tell me a little bit about that, Anne.
Yes. So what we do with that is really work on three key important things with our clients, right? So the first one is understanding your existing tax picture, right? So really looking at it and building out a strategy for the next few years of all of your income sources and what's really going on there. The second piece is through real estate investing, building out these 5-year plans to say, if we had a cash to deploy to 2 properties or 3 properties, where would we be as a whole in 5 years? And, what does that look like from a net worth standpoint? And then ultimately, treating these rentals like they're businesses and building out monthly budgets because a lot of times they're in seasonal locations. And a lot of times the investors really haven't done budgeting before. And so our team will work with you to set some KPIs for the property to make sure that we're running it efficiently and we're focusing on, the nightly rent that will get me to where I need to be and, taking some of that stress off because a lot of times this is your first side of, being a business owner, and, just having those monthly targets can really help it feel less overwhelming. But I think as a whole, what we've seen is, by going through the process, by really giving you back control as the investor, that you now, have a much better picture of where you can be in 5 or 10 years, being in that driver's seat. And I think that's the priceless piece, is now you are driving your own destiny.
It's amazing. Having the ability or resources or team members around you to track everything, track every penny all the time, update it, review it as soon as possible, because it's so much more difficult 3 months later to figure out what you spent 24/37 on. And then, finding that receipt, attaching receipts to transactions. I mean, these things make life so much easier. And that budget idea then is like the dashboard that you have to say, okay, this is my steering wheel. Can I do this? What's the return? What happens if I don't? Do I wait till next year? And really looking at, kind of like that CapEx piece of that as well, too. So we could go on for days and days and days and days, and I might even cry in those conversations because of what I've went through in my life with taxes and business. But it's the idea of being able to have these conversations and share with everybody else, because even if you don't understand all of it, there were little bits and pieces or little seeds that should have been planted, because this all makes sense to us. In the confusion, there is sense, right? In the convoluted code, in these books of stuff that don't make sense, whatever happens moving forward, this is good stuff to know. So thank you so much. It's been a very fun conversation. We should play golf sometime.
We should, yes.
You will whoop me, though. I'm not a good golfer.
No, yes, that would be good.
You would definitely take advantage of me on the golf course, probably, but it would be fun. We would have great conversations. But no, this has been absolutely amazing. Where can the listeners find out more about the Accelerator Method?
Yes. So check out our website, acceleratormethod.com. Or you could just, there's a form there to fill out to reply or to get more information. And we will send you our newsletter, which comes out every week. And
there's, I'll have it in the description, but there's a hyphen, like a dash inside of that accelerator. So it's accelerator-method.com. And we'll put that in the description as well, too. Reach out to Anne, take her up on the golf invite that she just invited every listener today out to golf, and talk about real estate and taxes. It's all good at the links, right? Thanks again, Anne. Have a great day.
Thank you so much.
All right. Well, that conversation was a blast, diving in on some of the topics in and around tax strategy and wealth building and real estate. Well, again, thanks again to Anne. What a great conversation. Here's some notes that I jotted down from the conversation today. Know your effective tax rate. Most investors don't realize how much they're actually paying in taxes. Short-term rentals are powerful, but they are not passive. Treat them like a business. You must treat all of your real estate investments like a business. Long-term wealth requires strategy. Understand your numbers and plan for the future. If you're ready to take control of your real estate tax strategy, be proactive instead of reactive, check out the acceleratormethod.com and connect with Anne today. That's accelerator-method.com. It's in the show description. Thanks again for checking us out. This is Real Estate Mogul MD.